Goons. We're back again for another episode of Jack of All Trades. With me, as always, is Kaylin and our producer Sam. And I thought today was interesting. This past week was a big week for my mom's portfolio, which I took over in January, and I just wanted to go over kind of the importance of actively managing your portfolio, or if you can't or don't have the time to do it, like get somebody to do it because hers is a great example of a contrast of what can go wrong and what can go right. So let's get into it. So Sam, if you could share my screen, I just want to show. So I took over her portfolio in January. So year to date, it's up 27%. S&P is up 17%. So right there, not to toot my own horn, but I can beat like 80% of fund managers who can't beat the S&P. I just beat them. But the reason so here's the thing though. Her portfolio, she's had it since 2009, and it's up 230 something percent. In over 10 years. That's like underperform. Or, yeah, in about 10 years, that's like heavily underperformed because if I kept doing 20 something percent year over year return, she would have like quadrupled or quintupled her money by now. And so when I took over her portfolio, I remember Kayla was telling me about it. She had two holdings. She had a bunch of cash and she had two holdings. She had Apple and she had this drug company. I told her to get out of Tesla because that's when Tesla hit all-time high. But she was in a drug company. I looked at the chart and I sent it to you. I'm like, dude, this is. I was like, this frightens me. You remember that?
Yeah. So I've played that one a million times.
Yeah, I remember you told me that. Cause I'm like, yo, this dying stock, and the reason she's in it was because she used to work for that company. She's like, that's the only company I know, so I got put money into it, right?
Yeah.
But it's just funny that you were like, and you're a short seller, so I'm like, so you've been shorting that for years while she's.
Yeah, probably not a good sign, I guess.
And it kind of explains the performance a little bit. But so that's her, right? She's a little bit cautious. Like she just viewed it as kind of like a bank account. Maybe she'll invest in it, maybe not. She's just kind of money she'll store aside because this was her RSP. But she did go to TD, or rather, they approached her and then they put her into these two products. So that's her RSP. They put her into this financial planning product, an RSP and an RF. I don't even know what that stands for. But I wish I took a screen capture of the performance. So basically, in the same period as the RSP, when the RSP went up 200 something percent, this one was up 14%, and this one was up 17. That's
over 10 years, right?
Yeah. I mean, if they were up 1% a year, even compounded, they would be like higher than that.
Yeah.
So I mean, and then we were just looking because I couldn't find what was in these products, but we were just doing a little search on TD's website, and your eye caught the aggressive growth portfolio,
which is up what, like 9% in 10 years?
Yeah, which is up 8.7. Didn't even hit 9. 8.7 in 9 years. Oh, by the way, it's down 3.4 this month.
What the hell, man?
It's down 3.4.
Either we're not understanding this at all, or this is like the fucking worst thing I've ever seen in my life.
It's like getting punked. So aggressive.
Honestly, the only thing that makes any sense to me is if all of that stuff is just like massive dividend stock, 5 to 7% dividend. That's the only thing that would make sense.
I just find it hilarious that it did less than 9 over 10 years, and it lost like a third of that in a month.
I honestly, I don't even know what to say to that.
But here, we opened it up and we had another laugh. So this aggressive fund is holding other funds, not stocks, other funds.
Dividend. And we got to point out here, so the biggest holding of the aggressive fund is a global low volatility fund, which is brilliant.
If I was my mom, I'd go up to the financial planner going, define aggressive.
Okay, but see, a lot of people don't understand this stuff, right? So like, we're not here to like make fun of everything. Like, we're just, there's obviously a lot of stuff behind the scenes here that we don't know because we can't see exactly what the stocks are that they're in, or if they're dividends or whatever. But if you're looking at stuff like that, like the key thing that, like, some of the questions that you guys want to ask if you're putting your money in with funds, like versus managing yourself, like we do, is, you want to get a really good idea what fees you're paying. Because one of the things that, I pointed out when we were looking at this is normally, like, anytime you give your money to a fund, there's always a fee. If you're going to take a maybe a 1% or a 2% or 0.5% or whatever the fee is. Like even if you just buy an index, like the S&P index, for example, you're still paying a fee because it is technically an actively managed fund. Like right? They brought Tesla in this year. So there is still stuff trading hands. I think it's like, I don't know if you know what it is, David, offhand. Was it like a 0.5% or
Here you go.
0.3 or something like that for the
So,
S&P?
well, if it's an ETF, it's 1%. Other funds, it varies.
Yeah.
Standard.
So if
No, go ahead.
Yeah. I was gonna say, like, if you put your money into like an actively managed fund, you really got to be careful with what you're paying for, because there's a few things you have to look for when you sign your contracts and stuff. Is you could be paying like say 2.5% on your mutual fund just for their own fees, and like if they'll actually give you a breakdown, so like you can read in there, like some things will say like miscellaneous office expenses, for example, which literally could be like the coffee in their break room. Like it could, like all that stuff is in there, so you have to be careful when you're reading that stuff. But like the thing to keep in mind is just like if they're giving you statements that says like, oh, say the S&P went up 10% and you were up 11%, so you beat the market. Well, if you're paying like say a 2% fee, then you actually only made 9%, so you're actually losing out on this people that are managing your money. The other thing to watch for is, with mutual funds, they're trading within the fund, and depending on which fund it is, a lot of the
Sure.
times you'll still be charged commission on those trades, and you'll also might be taxed capital gains, right? So if they're not holding positions for more than a year, you could be paying income tax on some of your investments as well. So there's that to keep in mind. And then with this one that we're looking at here, where it's saying you're putting your money in this fund, which holds 15 other funds, now you have a whole other layer of things you have to look at, where you have to say, okay, in each one of these other funds that my fund is holding, am I paying fees to my main fund? And then what other fees am I also having to pay from these other subsequent funds? What other commission fees are they paying on my trades or like there's all these layers of things, and like there is a lot of funds out there that don't charge you that. It'll be like, you put your money in the main fund and it's like, it'll be 1.5%, which is reasonable if they're doing well enough. And then all the funds that they're investing in, there's no additional fee. So you don't have to be scared just because you're seeing something like this, but those are huge things you guys want to keep in mind, because if you're putting your money away for like, 20 or 30 years, you look at it on paper and you say, oh, okay, like between all these funds and the taxes or whatever, like I'm only losing, quote unquote, only losing, say, 2% a year. That 2% over 30 years, like even for like a modest investment fund, like you're talking hundreds and hundreds of thousands of dollars when you go to retire. Like it's a lot of money. So you guys, like it's something you really need to be aware of and be careful of when you give your money to people. So I just kind of wanted to make that point.
No, that's an excellent point. That's actually why, when I left Brinks, I took what was managed back then and managed it myself, because it was the exact same thing. I was putting some product that was holding banks and some like other non-growth stuff. It was risky. That was the risky one, and I was getting hosed by the funds. Like I should have been making money every year, but because of these percentages, like this portfolio's percentage, it's management fees 2.323%. Then you're getting dinged
Mm.
per trading, like you were saying, and there's another funds expense. There's another, so you're out 4.5% before anything else.
That's way too high. 4.5% is absurd. I'd run for the hills if I knew I was getting charged 4% on my fund.
Yeah.
That's insane.
And so that actually explains the popularity of ETFs that came, because ETFs are like, they're not actively managed. The funds cost is usually 1%, maybe 2 at most, but $3.9 trillion are wrapped up in it, and they came out of nowhere. And it's because of
Mm-hmm.
costs, like this, right? If the S&P 500 on a good average year does 7%, 4 of it goes to this management fee. I'm only taking 3 at
Yeah.
home. Like what the hell?
Yeah. Well, think of it this way, guys, because I know like it seems small when you think 4%. Oh, 4% is nothing. Think of it this way, and it's going to sound a lot worse. The S&P in an average year does 10%, right? So if you're in an actively managed fund that's matching the S&P for growth, 40% of your profits are 40% of your growth every year, because you're 4% out of the 10, right? So you're losing 40% of your potential returns every year if you're matching the S&P.
Whoa. Sorry, just I think I pulled up the inverse VIX, because I'm just trying to pull
Was it
up
the
like, yeah, it was the inverse. I'm just trying to pull up like just to give a like an idea of the SP 500 ETF, just the random ones. You see what it looks like because I pulled up the VIX, which is wrong. Then there's the bull.
Mhm.
Uh,
SPX, right?
yeah, which one's on a more reputable Investco low volatility ETF? Is that the one? There you go. Look,
Mhm.
since COVID, it's up 71%. You know, like well, I'd say if you time the bottom, but let's say you bought randomly here in the middle of 2015, 56%.
Yeah.
Right? That's like what's 6 years. That's a very good return for 6 years.
Yeah.
For one where you're not, you just set it and forget it. You know,
Yeah. So if you were getting charged 4% every year, then you're down 24% over that
well,
period of time. If your fund can match the S&P, which I'd like to point out, the vast majority of funds do not do, surprisingly enough. Most funds do not beat the S&P index, and you're at 24%, but because that's compounded over those years, you're actually out significantly more. It's probably something like 36% or 37% because all the money you lost in that first period of time, you go over the 1 year, say it's 10%. Well, you only gain 6% because you were paying 4% in fees. Now, the other 4% that you would have had that would have grown now doesn't exist. So, it's not as simple as just saying, oh, well, I lost 24% over that many years. No, it's the compounding effect of it as well. So it's really probably, like realistically, you probably would have only made like maybe 20% growth if your fund
yeah.
was matching the S&P and you had 4% fees when the S&P actually did almost 60%.
And look at this. Like 2 to 10 years, they at a loss, pretty significant loss. The other 1, 2, 3, 4 years, they made have matched the S&P's 500. So 6 out of the 10, they couldn't beat the S&P 500.
Yeah. And that's the shit thing too with a lot of these funds is like the way they advertise is like they'll put up a chart like that and be like, oh look, we had this many years that were close and we had like a 21% year and a 16% year and they just kind of ride on those for just ride that as long as they can to get investors. Like it's kind of a sleazy market, like for lack of a better term. It's just like there's a lot of really good ones out there that make you a lot of money and guys know what they're doing. They're smart guys, and their goal is actually to help you. But the problem is, a lot of them just get their money from having investors. They get their money from these fees. They get their money from trading commissions. So they don't really care. Like the best funds to look for are the funds that only profit if you make money. So like they take a percentage of your profit. Those are the best ones. So if it's like if their fees, for example, are say 2% of your profits, that's a better thing to see than saying our fees are just 2% of your money. Because if it's 2% of profits, then their goal is to make you as much money as possible. Because the more money they make you, the higher that 2% is for them.
Yeah.
Right? It's just human nature.
I never did ask what Brandon's family what they charge for their mutual fund, but I know their fund is
It was
special in that.
low.
Oh, is it?
Yeah,
I
it was low. It was. I don't want to say what it is, but I know it was reasonable.
and well, the selling factor for me, and I think it's great for the audience to know when you should ask a PM portfolio manager is Brandon's fund. They have the majority of their own wealth in that fund, so it's in their
Yeah.
best interest to protect that wealth. I mean, that's a huge thing.
Yeah. Plus, all of them, like even their personal accounts, are also investing all the same stuff they're putting their clients in.
Yeah,
So,
exactly.
and there is a lot of funds out there that are like that. Like there is really good fun. The problem is there's so many. It's so easy to set this kind of thing up and just scam people because they have no idea. Right? Most people have. You just look at the thing and you say, "Oh, it's a mutual fund. Like here's some numbers. Everybody says invest in the stock market. I don't know what I'm doing. My buddy told me about this guy, so here you go." And then you just ignore it. You don't think about it for 30 years, right? But it's so much money. Like it's so much money that I think everybody should educate themselves to the level of understanding what their fees are and how much it can cost you over time. Not the stocks, not how the market moves, not the economy, just simple fees and how they work and how much it can cost you. It's really simple math. Any contract you get from a mutual fund will tell you that in the contract if you take the time to read it.
what do you think about this analogy? That shopping for a mutual fund is kind of like shopping for a personal trainer, right? You want to lose some weight. You could go to a bank, which is akin to going to Good Life, or you could shop
Right.
around and find like that one good, from word of mouth, people who've had results, right? You find a
Yeah.
portfolio manager or a financial advisor, it's like that.
Yeah, for sure. It's like you see the guys at Good Life that it's like a 2 day weekend course, and they come up to me and try and train me, and I'm 4 times bigger than them. It's like, really,
Yeah.
dude? Like, like I want to get trained by the guy who's bigger than me, who's been winning shows for 10 years. You know what I mean?
Yeah. Because I should point out that I'm not shitting on the entire industry because I know a few
No.
people that are not portfolio financial planners, and they're pretty good, but they don't work for a bank. They work for more independent shops, and they'll care. Because
Mhm.
actually, my buddy has a great explanation. He's like this. He's like, if I give my clients a return, they're gonna want to reinvest. That's more money for me, right?
Yeah, because he probably gets a percentage of their
Yes,
profits.
yes. Whereas
Yeah,
the
exactly.
opposite
That's
side. Sorry, go ahead.
No, I was gonna say that's just like
Oh, okay.
probably one of the number one things to look for. Yeah.
Yeah, yeah. And I know the opposite side where it's like if you're somebody that works at TD, you get a commission out of every product you sell, but you have no interest in whether or
Yes.
not it goes up or down. You're just trying to sell me a product.
Yeah, most funds that are run through banks are like that, and I say most because not all of them are. There is a lot of funds like in RBC and TD where they do not operate like that, but you do have to be really careful if you're going like most people go through banks because it makes the most sense, right? They're money managers. But most banks, they're brokers as well. Like you have TD Direct Investing, you have Scotiabank iTrade, you have RBC, like all these companies, they have their own brokers. So it's like David, like you have a TD account. So every time you make a trade, it costs you $10 in and out,
Yeah.
right?
Yeah.
So it's perfect, right? Like the more customers they can get, the more money they can in. Every time they can make a trade, they're making more money, regardless of whether or not the stock goes up or down, right? So that's a key thing to look for. But again, that's all written out in the contracts that you sign. So you can go to a bank, just make sure that it's not going to be that kind of a situation where the only source of their income is their standard fees, which you pay no matter what, and then commission on top of that. Because then that like those two things right away tells you that fund manager has zero interest or desire or reason or money incentive to make you anything. Like that, no matter what your portfolio does, they're still going to make the same amount of money, right? It's like being in like a government job or something, for example. Not to shit on government
Yeah.
jobs, but like there's no incentive, right? Like think about if you're doing like if you're building an extension on your house, like you have to get permits for the structure. Well, you give those permits to the town. The town has no incentive from you to be quick, to be helpful, anything, because
Thorough.
they're getting paid regardless, right? They're getting paid by the taxpayer money. It doesn't matter if they piss off one person or go slow or take a year to do permits that they could have done in a week because they didn't feel like it, because there's no incentive. It's the same thing, right? Whereas if it was like something along the lines of where the more efficient they could be delivering these permits back, and the more the quality of the structure, like however it was laid into it, if that was all how they were going to make money, you would be seeing the best buildings going up. The permits would be flying through like crazy. Like it would be a fantastic system, right? There has to be incentive.
Yeah. That's right. The government job is like you're just that file that stands between them and lunch. So they're like, fuck that file, I'm going to
Yeah,
lunch.
100%, man. That's why it's so hard to find people that are good to work with in the city.
Yeah, man. So I think this is a good episode in trying to teach people like we're not trying to give you any style or anything like that, but like at least know what questions to what's important to think about. I think
Yeah,
it's just like finding a what do you call it, a personal trainer, right?
yeah, yeah, for sure. It's just but the nice thing though is that like you don't have to be scared of it, and you don't have to know anything about the economics of the markets or any stocks or anything. It's literally just all it is reading a contract and looking at where the fees are going. You just have to think objectively and say, okay, like I don't pay this person unless they make me money, and the more money they make me, the more money that they make. Like, okay, that makes sense. They're gonna be motivated to make me a lot of money. But if you look at it and at the end of the contract, you're thinking, okay, this person, there's not a single incentive in here for this person to make me money, and they're going to make money regardless, then well, that just seems kind of sketchy to me, right? Like why would they even want to put the time of day in to do well for me if they get nothing else out of it?
What do you think about this? If let's say you're looking for a financial planner, immediately my thought is this: like one good way to tell if this person is honest or not is they're more than willing to give you more information. They'll tell you as much as possible instead of going like, you don't need to worry about this. We'll take care of that, or that's something above your head. Give you that impression that's above your head, or like, yeah, whatever you want to know, we're going to explain it down to the T.
Yeah, yeah. Well, the shitty thing too that I like, I don't think it's like this across the board, but like it comes back to the same old thing. Like the more money you have, the better your options are, right? Like the guys that have $10 million to throw into one of these accounts, they're the guys that are going to get the really good people because it's not volume based, right? Like those guys that are investing their money, their fund manager who's making 1 or 2 or whatever percent of their profits, like that's a lot of money. Like if you're moving $10 million, like you really want to move that $10 million. 2% is going to be a lot of money for you. And if you have 10 clients, you're hustling every day to make them as much money as you can. Whereas like, you get people on the other end of the spectrum where it's like, okay, maybe I have $20,000 or $15,000 to invest. People that are managing those accounts, it's harder to find because for one, there's certain levels of accounts where, they might have a $500,000 or $1 million minimum. So you can't even get into them.
Yeah.
And then outside of that, it's like, if you have $15,000, even if there is like a 2%, fee that the guys earn on the growth of your portfolio on such a small amount of money, it's like, oh, whatever, this is a couple of bucks kind of thing. And then it just becomes, it could become a numbers game where they're managing, say, a couple thousand portfolios that have $15,000 in them. So then it's worth it. But that's just also a big headache because then you're dealing with so many different clients, right? So it's kind of the shitty reality of the fund world in that sense, is that once you have a lot of money, it's easier to make money. It's the same thing all the time, right? So it's just harder when you're getting into it, which, I mean, everybody starts at that level unless you're, you have some giant inheritance or something, but
You know what? I'm glad you pointed that out. I forgot to mention, like Brandon's fund did. I don't know. Remember the? I don't know. I forgot what stats he was saying, but they've been beating the S&P for like quite a while. They were on a streak. But the problem is his fund doesn't. His minimum investment, I think, was $100,000 or $150,000, something like.
yeah, yeah, exactly. Like I
So
know
it's like,
the ones that my dad are in, like the minimum investment's $500,000, right? So it's
so
like,
yeah. So
it's not like, everybody and their mother can go and, invest in this account. So
so what do you think about this? If for people that are actually average, they buy the S&P 500 like an ETF in the S&P 500. I just want to show them the performance real quick. So the S&P 500, for those that don't know, is just a collection of the 500 companies listed on the U.S. stock exchange. And so let me pull up the monthly performance. I mean, yes, over the years you're going to have these like giant, let's see, what is this, 30, 40%. Oh, that's a 15% pullback. 2015, obviously you have COVID, that was like 50 something percent. This was the financial crisis, that was 57%. But let's say you bought midway through 2005, so it's not quite to the top of the financial crisis, right? If yeah, you took a ride down, but if you just held, you would have gone up 270%, 275%
mm.
over a 12-year span. That's a
plus your
fantastic.
dividends that plus your dividends that you're earning on the S&P index, which you can keep rolling back in. So you're actually earning more than that 275 because you're
Yeah.
actually getting dividends quarterly on this as well.
Yep. And if you're doing an ETF, you're paying that 1-2% fee, which is quite
Yeah,
reasonable.
it's lower than you'll find on any mutual fund for sure.
Yeah. So I think
Yeah,
the two
I know
options is
it's
this. Sorry.
yeah, no, I think I was basically going to say the same thing you were. Is that the two options are, see if you can find a really good money manager, put your money in the S&P, or like, I
Put my
mean,
money.
if you're young, you could do a bit of both, right? Like if you have some money, you could look through the contract, find a mutual fund that you think is really good, and split your money. Put half with them, half with the S&P if you have enough money to do so, and then see which one does better. Because the tricky thing is like there is indexes like the TSX. I know hasn't done that great historically. Like I think if you look at I think it's the Japanese index. Didn't it crash like 20 years ago and it still hasn't come back to those highs?
Yeah. Hang Seng.
Yeah. So like there's still risk. Like it sucks. You're never going to be riskless. I mean, like the United States realistically is probably one of the best things that you can bet on, and they're until they're not the world powerhouse, which I don't see happening anytime soon, then you're pretty safe because if something happens to the US economy, the whole world's affected regardless.
Oh
So
no
any
doubt.
other index you're in is still going to go down. And then, they're just they're just the hub of everything, right? They're the hub of the whole world. So it just makes the most sense.
So I was gonna say something about the because I was learning more about it because everyone's talking about inflation and the example because they're like the only developed nation that had was it negative interest rates for a little bit and whatnot. So they
Mm,
had this stagflation. Yeah, here we go. They peaked in 1990. Still not there.
yeah, I
Still
know.
not there.
So 30 years and it's still not those.
And
That's
the
the
thing
Japanese
is,
one, right?
yeah, but there's something
Yeah.
really weird going on with their market. I don't think they're basically trapped because and the US kind of smartly sidestepped this thing with their money printing and their bonds.
Mm,
They finagled it. But what happened with Japan is that I think the Bank of Japan owns like 40 or 50% of all the corporations. Just to save
mm.
them, they bought all the shares. They printed money, bought all the shares. I think that has what's keeping them low and underperforming.
Right, right. Yeah,
But
it's kind of like when you look at it like that, because the thing too is like if you're buying into like an index, like realistically, you're not just like one lump sum and that's it forever. Like you're buying into it consistently. So I mean, this is probably the worst example we can look at where you know it still hasn't gone back to the highs. But like realistically, even if you're still, if something takes, if something gets to a high and it dips relatively down, it comes, say it takes 20 years to get back to those highs. Through those 20 years, you're still buying in, buying in, buying in. So by the time you get back to break even, it might only be 10 years, right? And then you start getting in the money again. That's the other thing you guys got to keep in mind. It's not like, okay, I'm all in here and then it takes me 30 years to get my money back. It's like, no, you start here and then you're just buying pieces all the way through, and that's pulling your average down. And then eventually you're going to get back to break even, like well below those previous all-time highs.
actually, that's a great example of dollar cost averaging. I do that with my swings because you never
Mm.
know. And you rarely get the perfect entry, right? So you get a
Yeah.
range, and it's like I'll enter
Well,
here, and I'll just keep buying.
yeah, because it's growing as a whole, right? Like it's like the S&P, obviously, America, like the biggest thing in the world is it's even if you're going into a bull market like 2008, like all or a bear market, sorry, like all through that, if you're still just buying in, like every month you put money aside and every month you buy a little bit more into these indexes, then as the markets are going down in a bear market, you're just slowly pulling your average down. So it still is better in the long term.
I should mention that what we're talking about is investing, not trading. I think a lot of people, right?
Yes.
Because now that we're talking about the long term, it's like my first and by far largest account is an RSP. I pay that 10%
Mhm.
trading fee because it's a fucking RSP. I can't like I like to take the money out, right? Like I'm not touching it till I'm 65. So yeah, I'll eat the $10 to make a trade,
Yeah.
right?
Yeah, exactly.
But I got into the TFSA too, and I didn't shop around. This is a good example of shopping around because I didn't shop around. I just like all my accounts are at TD. I was comfortable with it. I understood the system, so I opened my TFSA there, and I'm still paying $10 a trade for my swings now. But whereas like Interactive
Mm.
Brokers, which you use, and which is the other one you use now?
I have three. I have Quest Trade, Interactive Brokers, and Alliance Trader. Those
Yeah,
are
and the
my three.
fees are a lot better, $2 or
Yeah,
something.
Quest Trade's $5, up to 10, depending on how many shares you buy, and then Interactive Brokers is a penny a share, I believe, and then it goes up to I think it goes up to 10 as a max as well, and then Alliance Trader is $1 no matter what over I think 300 shares it starts to go up, but then I think it's still max. So it just depends what kind of size.
Yeah, so I mean, I'm comfortable locked in with my RSP and TFSA at T, but my TFSA have starting to hit the limit. So whatever overflow I have, I'm gonna use that Interactive Brokers account. So I'm getting
Yeah,
that
because you,
ready.
you can still open a TFSA with Interactive Brokers too, right?
I can. But I just, you know how we both compartmentalize stuff. I'm just like I'm so set with that section. I'm like, if I do just cash trades, I'll just do it with IB or something.
Yeah, I'm the same way. Like I like my Questrade account's my investment account. I look at it like a month, like once a month, and then my other two are shorter term accounts. So there's way less money in them, and everything, all the profits just go into the investment account.
Yeah. So why don't we end it with that? Like people, I think this episode gives them a good basis to know what questions to ask. And the last thing, which I think is important that people don't talk about enough, is compartmentalizing your portfolio, your intention with the money. Right? If you have a chunk of money you want to invest, don't trade with it. Don't act like a trader with it. Don't think like a trader with it. Just invest it. And then if you have a trading account, then use another thought process for that.
Yeah, sure.
Cool. All right, YouTubers, goons. We'll see you again later.